Hi everyone, in this video we're going to be taking a look at Chapter 5, and in Chapter 5 we're going to continue on with our discussion of the accounting cycle, and specifically we're going to look at adjustments or adjusting entries. Okay, so we're going to begin, like I mentioned, talking about adjustments as they call them here, adjusting journal entries, and then we're going to look at this will be like an overview of adjusting entries, and then we're going to look at some specifics of the different types of adjusting entries, such as accrued revenue, expenses, unearned revenue adjustments, prepaid expense adjustments, and finally depreciation. Then we'll take a look at the adjusted trial balance, and end this chapter with a look at related ethics and internal control considerations. Okay, so to begin, we've got this diagram here of the accounting cycle, and we've basically made it through down to preparation of the unadjusted trial balance. So if you will remember, step one of the accounting cycle is just to analyze what's happening in the business, essentially just look at different transactions and be able to translate that information into journal entries, essentially. So that would be step two, journalizing those transactions. After creating the journal entries to record the transactions accounting effects, then we're going to, as I mentioned, so we journalize those. Then we take those journal entries and we post that activity to the general ledger and the specific ledger accounts for the accounts that were affected by the journal entries. And then once we're done recording all of the activity, all of the kind of day-to-day accounting transactions, and doing all those journal entries and ledger postings, and we have final balances, or at least unadjusted final balances, we take those and prepare the unadjusted trial balance in step 4. And so here in this chapter, we're going to start looking at the next step, which is to then journalize and post the adjusting entries and prepare the adjusted trial balance. So as we've kind of alluded to and actually discussed directly in some of the previous chapters, there's this concept of an accounting period, and the accounting period is just the period of time covered by the financial statements when you look at them. And when we hear this term fiscal year, which you will hear sometimes, you will know the definition of that to be a consecutive 12-month period that a company chooses for its financial reporting. So it doesn't have to necessarily be January to December, like a calendar year. We typically think of a year as January to December, but some businesses and different organizations, etc., will have a different 12-month period, and we'll call that their fiscal year, which may not end on December 31st like the normal calendar year. So a 12-month period for a lot of government organizations ends on June 30th or in the middle of the year. Some retail organizations will have a year end that I believe is in January or February, more in the beginning of the year. And the reason that a company or an organization, sometimes it's a requirement, but a lot of it has to do with their the financial aspects of their business and the way that different cyclical patterns happen within those organizations when it comes to funding. And maybe for retail organizations, the month of December and kind of the end of the typical calendar year is a really heavy month or two with the end of the year, Christmas sales and things like that. And so because of the cyclical nature of some of these organizations, they may choose a fiscal year, like I said, that does not necessarily end on December 31st, but instead ends at a different month. But we're still going to be talking, if we're talking about a fiscal year, an annual period, it's still going to contain 12 months. It just might not end on December 31st. Okay. So the idea of these adjusting entries is that they are made at the end of the accounting period, and they're going to adjust certain balances to reflect revenue and expense recognition, essentially. We've already looked at some of these concepts in previous chapters. For example, when we prepay a prepaid insurance contract for 12 months, and then at the end of each of those 12 months, we reduce that balance of that prepaid expense asset by 1/12. When we are doing that process of reducing the prepaid expense asset and increasing the expense, and that is a process, technically it's called amortization. And so when we are amortizing that prepaid expense every month, that is us doing an adjustment. Okay. So I think, we've done this several times in different chapters. We've talked about this quite a bit with things like the prepaid expenses. Some of these other concepts like depreciation we haven't yet touched on directly, but when we dive into some of the specifics, just keep in mind that we're not doing anything radical. In some of these adjustments we've already dealt with and learned how to account for, especially in the realm of things like prepaid expenses, as I mentioned. Okay, so here we've got a little question, and which of the following does not require an adjusting entry? And when we look at these, we can kind of refer back, to these topics here. This is kind of a funny breakdown. Oh, I guess they're saying which does not require. Yeah, so depreciation is an adjusting entry kind of concept. What we're depreciating is going to be long-term assets like equipment or automobiles, etc. Accrued expenses, we will accrue some expenses, and unearned revenue, often we'll have to look and analyze unearned revenue to determine whether we actually earned some of that revenue during the period. But owner's withdrawals are not ever part of the adjusting entries. Remember, those are just capital or equity decreasing and the business's cash balance decreasing. Once that's done, there's no process of month-end adjustment or anything like that we have to consider. Okay, so let's look at the first specific type of adjusting entry, and that would be adjusting entries related to accruing revenue. So we've already kind of talked about this concept of accruing revenue in previous chapters, and when I say that, I mean that we've already talked about accounts receivable, and that's really going to be the primary type of account that we're going to adjust when we are talking about any kind of accrued revenue adjustment. So if you remember back to previous discussions of accounts receivable, they're essentially a placeholder, if you will, an asset account that we increase to reflect the fact that we are now going to receive cash in the future at some point from a customer. And so this is a typical journal entry, and you'll see these journal entries not just as adjusting entries. Most commonly, you see accounts receivable just being used in more of the non-adjusting entry journal entries, just things done throughout the month. So if we earn revenue from providing services or selling products, but we haven't been paid yet, we're always going to use this accounts receivable. So it's not only an adjusting entry, something that we're going to consider at the end of the accounting period. But with that said, it is sometimes part of our adjusting entries if we get to the end of the month and we do some sort of analysis and we realize that there is a portion of revenue that we've earned during that accounting period that we have not yet accounted for, essentially. And here we have a pretty good example of a situation that would necessitate that kind of adjustment. And like I mentioned when I was talking about accounts receivable, it's very commonly used just in general, journal entries throughout the month in typical run-of-the-mill business transactions. But in a situation like this, we're doing a little bit more analysis, if you will, a little deeper analytics to figure out what we are owed. So in this example, we have a contract with a client, and it's stating that we will provide them with services for 30 days. And you can see that contract starting not on the first of the month, but on the 21st of September. And the contract's worth $6,000. So if we're assuming so here we've got 30 days. And so if we are trying to account for the amount of revenue earned in September, we have to look at that and say, at the end of that month, how many days did we actually provide services in September? And so basically 1/3 of the contract, pretty easy math, we would see that we've earned $2,000 in September. And so that's where you get this kind of journal entry down here. So very similar to the normal transactions that occur in, like I said, day-to-day business when you provide services or sell products and aren't paid yet. But sometimes it does fall more into our adjusting entry category when we're doing something like this, where we have to analyze a contract, figure out, whether we've recorded all of the revenue. And that's really the goal of what we're doing with all of these adjusting entries, is looking over our balance sheet and our income statement and really just making sure that we've accounted for all the revenue and expenses, etc. And in this instance, because we already had this contract in place, it's not something that we are just booking a receivable for one transaction necessarily. It's like this ongoing process here where we're trying to separate the income into the portion in September, and then the residual portion will be in October, etc. So hopefully you can kind of see how there's sort of a difference between when we use accounts receivable just for single transactions versus where we need to do this kind of analysis and adjusting entry because we have some contract in place that covers a period of time, and we have to do some of that analysis to figure out how much revenue we've earned over that time period. And then it just gives us an example here of now in October later. So the first month's entry would be this, just to increase the receivable to 2,000 and put the revenue that we earned in September in the right month here in September. Now in October, we're going to provide the residual 2/3 of those services. It was 20 more days in October. So that's going to reflect here with the 4,000. We get paid the full amount of the contract from the client on the 20th, it looks like. So we got paid the 6,000. So then we reduce the receivable that we previously recorded here to make that go to zero, because when we receive that cash, we no longer have a receivable. And then we're going to record the $4,000 of revenue to represent that we earned 2/3 of that contract. 20 days of those services were provided in October, not September. Okay, we'll look at a quick question here. So if we have this company that signed a 1-year contract for $1,200, so $100 a month basically, to provide internet service to a customer from March 1st, 2017. So starting in March all the way through to February of the following year, how much revenue should we recognize in 2017 if the company has a December 31st year end? So if we look at this as $100 a month, because it is 12 months, we can see, and in 2017, we will have provided them services in March, because it began on March 1st, so the month of March is included. But January and February will be excluded, so it would be 10/12ths, so 10 months of $100 per month. So we will have earned $1,000 in 2017, and then in 2018, we'll earn the other $200 when we provide the services in January, and then here in February, which at the end of February, the contract concludes and we're not providing any further services beyond that. Okay, this question asks, to accrue revenue that has not been paid by a customer, in addition to crediting the revenue account, which account is debited? And again, as we've mentioned quite a few times here, that's going to be our accounts receivable. And that's really this definition of revenue that has not been paid by a customer. Remember, when we looked in previous chapters, when you provide services before the cash is received, that's when we use accounts receivable. Okay, let's talk about the concept of accrued expenses. So this is really similar to accrued revenue in some ways, but in this instance, we're talking about expenses and accruing those expenses. And the word accrual, in this context, is to basically build up the amount of expense and the obligation or liability associated with that expense that will eventually be paid in the future. Some examples of expenses that fall in this category are things like property taxes, salaries, or interest on a loan. So often at the end of a month, maybe your employees are in the middle of their 2-week pay period cycle, basically, right? So they may have worked 1 week in January, and then they work the second week in February, and then they're paid in February. So if that 2-week pay period falls over the end of an accounting period, like the end of a month, then we need to go at the end of that first month and make sure that we record the 1/2 of the total payroll expense that will eventually be paid in the following month, right? Because those employees did work in the first month, we just hadn't paid them yet till later. Similarly, interest on a loan kind of builds up over time. And so that's kind of, maybe that's a good way to think about these accrued expenses too, is just to look at your financials and understand, is there expenses building up that we need to capture that will not have necessarily been captured, by us receiving an invoice or through the kind of day-to-day ongoing expense triggering circumstances, like receiving, an invoice in the mail, for example. So here, let's dive in a bit more on the salaries piece. So as I mentioned, here's an example of this is some hypothetical company here. And if they pay their employees for 2 weeks, for example, every 2 weeks, the employees get paid. And the start of that pay period here is November 12th. And so this all goes through here, and then the employees get paid on the 23rd for each of these 10 business days, right? And so this cycle of 2-week pay periods just keeps going on and on and on. And so after this pay date, now the employees start the next pay period, which is begins on the 26th, and then you can see ends on the next month, the first Friday of the next month, December 7th, right? So here you've got 5 days in November that the employees have worked, but they will receive their pay on Friday the 7th in December. And so we as the accountants need to be able to look into the payroll system, for example, and the timing, and understand that we owe this money to these employees now, at the end of November, I should say, on November 30th for all these days, because those employees have worked those days, even though they're actually going to get paid the following Friday in December. So we need to do a journal entry to make sure that the expense associated with paying those employees gets put into November and doesn't just pop up here on December, because 1/2 of that amount that's paid here belongs to November, and then the other half will belong to December. So here's kind of an example for that. If we have an employee earning $1,000 every 2 weeks, they earn $100 per day if there's 10 working days, Monday to Friday. So if we have to accrue 1/2 of that week in 1 month in November, for example, then we're going to debit our salaries expense. So we increase expense in November, and then we're going to credit our payable. We're going to have this new account called salaries payable, which is going to reflect the fact that we owe the employees $500 as of November 30th, even though they will be paid, on December 7th. And then here's the following journal entry on December 7th. So this is the pay date, right? So cash goes out the door. Now we're going to reduce that liability that we've built up in November here with the 500, half of the total amount. We're going to get rid of that because we're now paying them that 500. And then we're just going to put another 500 to expense in December because this 500 here represents these 5 days that were worked in the same month of December when the payment was made. So I hope you can see how this is relatively similar to the accounts receivable transaction that we looked at, where you typically, you will have an initial entry to record a payable or a receivable to build that amount up. And then if the payment's actually made in the following month, you have to reduce that receivable or payable, and then also consider whether there's some revenue or expense that's associated, has been earned or incurred in that following month when the cash is paid, just like this 500 salaries expense here has been. Okay, interest expense is another common accrued expense category. And with interest expense, we need to keep in mind a few key terms on how interest is calculated. And so we need to know what the principal amount means. And we've talked about this in class previously, but just to remind us all that when we say principal, that is the amount that was originally borrowed. So if you borrow $10,000 from the bank and the liability back to the bank is $10,000, that's the principal amount. And once you pay all of the principal back, you basically don't have a loan anymore. You've repaid the full loan. The interest rate is an annual percentage rate that's charged on the principal. So if it's 10% on the 10,000, then you're going to owe whatever that is. It's $1,000 every year, basically, and you just calculate that by taking the 10% times whatever the principal is. Just in our little example we mentioned, if it was 10,000, it would just be the $10,000 times the 10%. And then we also need to know how long the loan will last, because especially sometimes the loans aren't even a full year. And so we need to understand when the payments are made and how many days or months we're going to be accruing the interest for. And so here's a formula that we can use for calculating the interest, which is to say, again, principal times the interest rate, like we talked about. 10,000 times 10%, we'd owe $1,000 per year of interest. But when we're looking at accruing interest, say for a month, then we need to also calculate that amount by the time in years. And we'll see an example of this, but just to throw this out for our little example that I was providing, if we had a $10,000 loan accruing 10%, that's again $1,000 a year. Remember, the interest rate is always at a year, an annual percentage rate. And then if we want to know what 1/12 of that would be, we would take that we would take the 10,000 times the 10% to get 1,000. And if we just want 1 month of what the interest expense would be, we take that 1,000 that we get from multiplying these together and multiply that by 1/12. Or another way to say that is we would divide by 12, essentially. So here's an example. So they have the business borrowing 10,000, but just for 3 months at a rate of 5%. The loan will be paid back on October. It was borrowed on July 1st. And the business prepares its September 30 financial statements. We haven't prepared any statements since the loan was received. So we have the entire amount of interest that we must be recorded. So let's decode what it's saying here. So we borrowed 10,000 on July 1st. So July, October, September. So basically what they're saying in this example is we haven't done any financials, so we haven't done any adjusting entries until the end of the 3 months. And so we need to just record the entire amount of interest. And so here you can see the 10,000 times 5%, we get $500. But we're going to do times 3/12 because this is the first time of us accruing any interest, and it's going to be 3 full months worth. So our adjusting entry then records the expense of $125 here, and we record a payable. Now we're going to call it interest payable to reflect the fact that after the end of these 3 months, we owe $125 back to the bank. And it looks like, we're also going to need to repay the principal here. We're going to owe them the interest, but we're also going to have to repay the 10,000, I believe, right? Because we said we borrowed this for 3 months, and so at the end of September 30, then that's the end of the 3 months. So here it shows the payment that we're talking about on October 1st, so the day after September 30, basically. So this is the principal portion being repaid, 10,000. This is the interest that the bank has earned, or you as the borrower have incurred that expense for interest. And then this is the cash that we send out to the bank. So the bank gave you $10,000 3 months ago, and then they get $10,125 back. And so that's how banks, make their money, through the payment of interest by their customers who are borrowing. Okay, we got a quiz question, a little quick question here. So which account is debited when a company pays the portion of the salaries that has already been accrued in the last accounting period? And so we are going to do salaries payable. We're going to debit because we've already accrued that portion. And so when we debit that salaries payable, we're going to reduce it to zero because we no longer pay it. And that's how we get rid of that liability. All right, here's an interest expense question. A company borrowed $5,000 from the bank on July 1st, 7% annual interest rate. How much interest should be accrued on December 31st? So we're assuming that no previous adjusting entries were made. So we just need to record all the interest for how many months is that? It's July, August, September, October, November, December. So 6 months, so 1/2. Pretty easy. And so annually, it would be a $350 charge, I believe, here. So 5,000 times 7% would be $350. But we have only had this loan for 6 months, so it'd be $350 a year. So we need to multiply that by 6/12, or another way to say that is times 50% or divide by 2. So 350 divided by 2 gives us the 175. And that's how much expense we need to accrue after 6 months. Okay, now we're going to look at this concept of unearned revenue. And this is a concept we've already talked about as well, similar to prepaid expenses. But as a reminder, unearned revenue is a liability that we will incur when we receive cash ahead of providing those services or products. Right? So basically the customer prepaying us this money, we're holding on to the money, and we don't get to own that cash. It may be in our bank account, but it's not ours until we actually, do the thing that we were contractually obligated to do by providing services, or products. And why this falls in the adjusting entries category in this chapter is because this is another time where we, as the accountants, for example, may need to look at the financial reports and look at that unearned revenue liability account. And we may need to do some analysis to determine whether we actually have earned that money. Did we actually provide the services or some portion of them, so that we can basically turn the unearned revenue liability into actual just revenue, and then we have ownership of that prepayment now, and the cash, in those bank accounts is now ours. So the adjusting entry that we would do to cause that to happen is to debit the liability of unearned revenue to reduce it, and then credit revenue to increase revenue. So basically, like I said, changing the liability to revenue as we earn it. So here's an example. Say that we are the landlords here renting offices out to tenants. And so now we are collecting prepaid rent from our customers, essentially. So if we collect the first 3 months rent in advance, $2,200 per month for rent, and on March 1st, we have a new tenant, they pay the $2,200 times 3 is $6,600. So now they've got rent paid up front for March, April, and May. And then we, on the property owner side, go in at the end of the month, analyze the records, and we see that, okay, yeah, we've got this tenant who moved in March 1st. They've, paid us the 3 months, And so now that the first month has passed, for example, we're going to earn that revenue. And here's the entry for the very first moment. Here is they move in. It's on March 1st. They pay us the $6,600, and we on our side as the landlord receive that cash. We have the money, but we put an unearned revenue liability in place to reflect the fact that this money is not really ours. We don't have ownership of it until the tenant has been there for the time over those 3 months, essentially. So here's an example of that. After 1 month, then we go in, we analyze, and we say, oh, okay, the tenant, they moved in on March 1st. Now it's March 31st. So one of these 3 months is now gone. And so we need to convert 1/3 of that unearned revenue liability into actual revenue because we've now earned it since they've stayed there for that first month. And so this is the journal entry to do that. Like we talked about on a couple slides back, we're going to debit that liability to reduce it by 1/3 of the $6,600. And then we're going to credit revenue so the resulting impact is we're going to reduce this liability, which was originally for 3 months on March 1st. Now at the end of March, we're going to reduce it by 1/3 so that ending balance will be $4,400, representing 2 additional months that the tenant will be there. And then, like I said, we also record rent revenue earned, and a portion of that cash that was paid earlier now becomes our owned proceeds, and we own that money now essentially. And then this is just showing us that so this is the 3-month process. So the original entry is to book the cash and the unearned revenue, and then every one of the 3 months after that initial payment period, we just do the same entry where we record $2,200 of rent revenue, and we reduce the liability by 1/3 until those 3 months pass, and we no longer have an unearned revenue liability at all because we now have earned all that revenue. Going forward at that point, I don't know if this problem will elaborate on it. We'd have to see how is this, does the tenant have to, again, pay 3 months at a time? I don't know. But at the end of May, we would have no more unearned liability. But if our tenant is planning to stay here, they will continue to owe us at least $2,200 a month. And so we'd have to look at the specifics of the contract, etc., to figure out how to account for that going forward. Okay, quick question here. You receive cash from a customer as a deposit. Again, that's this type of transaction that we looked at previously in prior chapters as well. So we're just debiting cash to increase our cash because they paid us, but then we're crediting this liability called unearned revenue to reflect the fact that we actually have not earned this money yet, and we have an obligation to that customer to do whatever it is they're paying us for at some point in the future. So yeah, debiting cash, credit unearned revenue. Here we have a question that says a customer paid a deposit 2 months ago, and this month you now provide the services. How was that recorded? So we don't touch cash in this instance at all because we already got the money paid when they paid us way back when. The money is just now ours essentially. And so we want to debit this unearned revenue liability to reduce that to 0 because it's no longer unearned, now it's earned. And we're going to credit service revenue to show that we did earn that revenue, in that month, whatever month that was, that we did provide the services. So debit unearned revenue liability goes to 0, and then credit service revenue to increase that. Okay, let's see here. Unearned revenue shows an unadjusted credit balance of $4,000 and a debit adjustment of $1,600. What is the adjusted balance? So in this instance, we're just taking the $4,000 credit, then minus the debit of $1,600. So $4,000 minus $1,600 leaves us with the $2,400 credit balance. Okay, the next category of adjusting entries that we're going to take a look at is prepaid expenses. And I might go through this one a little faster just because this is a topic that we've discussed quite a bit in previous chapters. And there's no difference really with what we've talked about previously. This is just us reducing that prepaid expense as we incur those expenses. So if we were the tenant, for example, in that previous example where we talked about prepaying rent for 3 months, at the end of each one of those months, we would record an actual expense where we debit that like it shows here, and we would credit that prepaid expense asset to reduce it for whatever portion of the prepayment was recognized essentially. So if it was 1/3, if we paid 3 months of rent and it was 1 month passing, then we would take 1/3 and reduce that asset by 1/3. So they've kind of followed that same logic here. So if we're in the previous example of unearned revenue, we were the landlord, but now if we're the tenant who has paid those 3 months, then just the same entry we've already learned about, debit this asset for prepaid rent for the full amount. Cash decreases because we paid that. So one asset down, one asset up. But then as the months go by, now we, at the end of March 31st, we need to do some analysis. We realize, okay, our prepaid rent needs to be reduced by 1/3. And so that's what we're doing here, crediting the asset and then debiting expense to essentially move this prepaid asset from being an asset to now being used up and being shown as an expense. So nothing new there. This shows you similar to how we saw for the revenue, that the expenses, if this is a 3-month repeated cycle, would just show up with that same cycle, those same 2 journal entries, with the initial prepayment and the expensing of that prepayment. And we just record the same entry at the end of each month because we have 3 months built into the 6,600. So at the end of these 3 months, now after we've reduced our prepaid asset by 3 months worth, 1/3 each time, now it's 0. And we need to figure out, again, just like we talked about with the unearned revenue, if we were the landlord, us as the tenant, we should, if we want to maintain good relationship with our landlord and stay in this location, etc., we need to figure out, what do we need to do going forward? Do we pay another 3 months? Do we pay month by month? So on and so forth. This problem is just a quick little illustration, so it doesn't delve into those concepts, but that's in the real world what we would want to figure out, because after 3 months, we no longer have any prepaid rent built up. And if we stay there without making a payment, then the landlord's going to be wanting us to send some money so that we're not just staying at this location without paying for it. Okay, another concept that we talk about with adjusting entries is the expensing of office supplies. And so the idea here is that office supplies, we can record those as an asset when we purchase them, because let's say, for example, we've got a whole bunch of paper or something for the printer, for example. So we buy a bunch of, let's say whatever. Let's look at the actual example. So if we buy $1,200 worth of office supplies, say, let's just call it paper for the sake of putting some context around these supplies. So we go to Office Depot, buy $1,200 of paper, and we just, same old entry we've done in the past. One asset goes down, cash. One asset goes up, office supplies. And then throughout the month, these office supplies, like this paper, for example, will be getting used up. We as the accountants don't necessarily or typically track the usage of office supplies on an ongoing basis during the month. So we're not sitting there tracking all the sheets of paper that are used up and reducing the office supplies little by little for each page that's printed, per se. That would not be, from a cost benefit perspective, that would kind of be a waste of time. But instead, what we'll do is we'll go out at the end of the month and just count how many reams of paper, how many paper things we have left, essentially. And if we count those up and we see that, there's only $700 left, that means that the residual portion that's not there, we originally paid $1,200, now there's only $700, so $500 must have been used. And so by inference, we just basically come up with this adjusting entry to reduce the balance of office supplies, which would show as $1,200 if we hadn't made this adjustment. And if we didn't make the adjustment, it would continue to stay $1,200, which would be wrong because we went out and counted and there's only $700 left. So in order to correct the balance of that asset, we reduce it by $500 and we increase the expense. Very similar to how the prepaid rent expensing looks. For example, one asset, the asset goes down, the expense goes up, but the overall context and the way that we figure out how we do this analysis, is a bit different, but hopefully it makes sense here. And really it comes down to doing that month-end count to see what's left. And you could imagine one thing just to highlight with something like this, it could be inferred. So we're inferring that the office supplies are being used up for, purposes of normal office usage and printing for the business. But if we are going back to do an inventory count later, we don't necessarily exactly know that the $500 was used. Maybe somebody stole $500 worth of office supplies, for example, right? So hopefully that doesn't happen, but this is kind of an example of where you might want to put in place some internal controls or processes to prevent supplies from being stolen. Maybe you put them in a locked cabinet, for example, and provide the key just to a central employee, so on and so forth. So it might not be a necessity. I mean, could be low dollars if someone takes a pen, or home on accident or something. That's not going to really play into the success of the business per se. But I just wanted to highlight that fact that there is always that risk if we're doing this type of analysis and inference based on a count, that we're really assuming that what's gone has been used for business purposes, but there is a risk always that might not be the case. And so that's where we as the accountants not only do debits and credits, but we look at business processes and try to put in some internal controls, as we call them, to prevent those kind of things from happening. Okay, here's a question. You prepay 6 months worth of rent with cash. How is this recorded? So just like the normal prepaid expense transaction we've been doing, so debiting an asset, prepaid rent to go up, and crediting cash. And this is at the moment of prepayment, maybe on the first of the month, for example. This is not the actual expense being recognized for that prepayment later. So debit prepaid rent, one asset up, credit cash, the other asset down. Okay, now last month you prepaid for 6 months of rent. Now you've used up 1 month of that rent as the month has passed. So now our second entry to get rid of 1/6 of that amount we originally paid here is to credit the prepaid rent to get it to go down and debit rent expense to go up. And that would be for 1/6 of whatever that amount was, because that's what we're saying 1 month has been used up. So debit rent expense, credit prepaid rent. Expenses go up, prepaid rent goes down by 1/6 in this example, and we're good to go. Okay, what type of entry to a prepaid expense account is required to adjust it to the correct value at the end of the accounting period? So what we're doing to adjust prepaid expenses would be to reduce them. Prepaid expense is an asset. So remember that assets, remember in our dead circle, it's the A under the D for the dead side. So it increases with a debit. And if we need to be reducing these prepaid expenses to adjust them correctly, we're going to want to then do the decrease side. So it would be a credit. So kind of a stream of logic there, but that's just another way of saying that assets are decreased with credits. And when we're adjusting prepaid expenses, which are an asset, we're going to be crediting those. Okay, here we've got another prepaid rent example. So prepaid rent shows an unadjusted debit balance of $6,000 and a credit adjustment of $2,400. What's the adjusted balance? So we're basically just saying we started with 6,000, so we're reduced that by 2,400. So that brings us down to 3,600 debit, I believe. We can do my math there. Yep, 6,000 minus 2,400. So we'll have a residual debit balance after doing this adjustment of $3,600. Okay, prepaid insurance is being adjusted for the amount used, whether account would be affected. So again, similar to prepaid rent, the rent expense, office supplies getting used up will go to supplies expense. And in this instance, prepaid insurance being adjusted will go to insurance expense. And remember, if we want to think, okay, we need to increase insurance expense, is that a debit or a credit? Remember that dead circle, our mnemonic device, has the E under the D. So it's the dead, the DEAD, and the expense part being under the D shows us that expenses increase with the debit. And so the debit will be an increased insurance expense. We're talking about insurance, so B is going to be the right answer for us there. Okay, so now we're going to talk about the concept of depreciation. And depreciation is something that you all might have heard of. It's kind of a concept that's thrown out there when we talk about often it gets thrown out when you buy a car, for example. You'll hear in kind of everyday speak that the value of that car will basically instantly depreciate when you drive it off the lot, for example. So the idea is similar in concept to that notion that when you purchase something, the value of it decreases because of the thing. It can decrease for any number of reasons, really. In the instance of everyday speak of the car reducing in value, really what we're saying is after it's no longer a brand new car on a dealer's lot, if you were to go try to sell it the next day, you would have to sell it for quite a bit less, because there's this, you're buying it from you're buying it used from a second party, not the dealer. Maybe there's something wrong with it. It's this concept just that the circumstances around that vehicle have changed, and so the value of that car has decreased, or the car depreciated. Now, when we talk about depreciation in an accounting context, it's similar to that idea, but how we're going to reduce the value of that asset is not going to be based on, how much the car could be resold for, whatever this equipment or long-lived asset could be resold for, but rather we're going to reduce the value of that long-term asset by a formula, essentially, that's based on what we as the accountants estimate to be the useful life, how long the machine or whatever it is that we're depreciating will be useful to us. We reduce it by a set amount over that estimated time period. So let's look at an example here. It says that if we bought a machine for $10,000 1 year ago, and depreciation of $2,000 must be recorded in that year, we have this concept of the net book value, which is to say the original purchase price minus all the depreciation recorded to date. This is our first year, so the only depreciation we will have recorded at this point in time that we're talking about is just 1 year's worth of 2,000. So at the end of that first year, and we'll look at the calculation how we come up with this number of 2,000, but we're going to say, okay, it's going to go down by 2,000 to 10,000, but we don't just reduce this machine balance. Instead, we book depreciation expense, and if we take that expense out of the original paid value, now this concept of the net book value, again, which is historical cost minus all of the depreciation recorded to date, or accumulated depreciation is the technical term that we'll use for that here, that concept, and we'll look at that in a moment. But anyway, if we're looking at the net book value at the end of that year, 10,000 minus 1 year's worth of depreciation, and it'll be 8,000. Here you can see that if we're doing 2,000 every year, at the end of the second year, we will have another 2,000 of expense recorded for the second year, but we will now have a net book value of 6,000 and an accumulated depreciation balance of 4,000 because 2 years of the depreciation has now built up essentially. So we'll look at that in more detail here as we go. And as I mentioned, this concept or this account that we're using called accumulated depreciation, which again is just, it reflects all of the depreciation expense to date, at a given point in time. And that account, accumulated depreciation, is a new type of account that we haven't seen yet, I don't believe, in our course. And that is an account called a contra account, as you can see here. And the idea of the word contra, I think maybe it's Latin or something to that effect, is basically, it means like opposite or against, or in an accounting context here, like we're talking about it, it's going to decrease the value of another account, essentially. And specifically in our instances here, if we're talking about the balance of a long-term asset, and long-term assets are also called property, plant, and equipment, or PPE. They're also sometimes called capital assets, so on and so forth. But in our book, we'll have this name, plant, property, and equipment, again to represent any long-lived assets. So our contra account of accumulated depreciation then becomes the reducing account for the contra asset to whatever specific plant, property, equipment, type of asset that we're talking about. So let's look at an example here. So if we purchased an asset for 10,000, and since it was purchased, we had 2,000 worth of depreciation expense recorded. So to preserve the original amount paid of 10,000, we don't reduce the 10,000 by $2,000 directly. Instead, we use this contra account, which will essentially, in effect, you'll combine the two together, and they will net or combine to show a net book value less than the original cost. So on our balance sheet, we might see, at the end of this, at this point in time, the net value of our plant, property, equipment, is 8,000, which represents the original cost paid less however much depreciation we have accumulated to that point. And in this instance, it's $2,000. And you might ask yourself, why would we not just go and directly reduce this $10,000 originally paid by $2,000 to reduce it down to a specific value, instead of using this contra asset account to kind of reduce it, but separately? And the reason that is done is kind of a practical consideration, because when you're looking at the accounting records and the details of assets, a business could typically have lots and lots of assets, and sometimes you sell an asset, or sometimes an asset just is thrown away or disposed of, etc. And one way that helps us track the cost and make sure that we're updating our records appropriately is for us to be able to look back at an original invoice of what was paid for a given asset. And since we're not reducing in our accounting records the original cost directly, it makes it a little bit easier to maybe look at this 10,000 and look at some invoice that was paid 5 years ago or something, and be sure that in our records, when we are, say, for example, disposing of something, that we're disposing of the right asset, or the one at least that matches up to our records. So it's really just a kind of a record keeping practical method by doing this contra asset with accumulated depreciation, just to help us retain the number here, so it's easier to reference that back to historical payment and invoice information, etc. So this is just a little more detail on the contra asset of accumulated depreciation specifically. So basically it behaves in a manner opposite to the way a regular asset account behaves. So if we know our dead circle, we know assets increase with debits and decrease with credits. When we're talking about the contra asset, as it notes here, it's just the opposite. So a contra asset will increase with a credit and decrease with a debit. So you can kind of see that written out here. So asset, plant, property, and equipment, increase on the debit on the left side. Accumulated depreciation increases on the right side, decreases on the left. So just the exact opposite, which is kind of what you'd expect, because this contra assets, the whole reason it exists is to offset the balance of the historical cost paid. So maybe you should be able to kind of see logically why you would have an opposite increase decrease there. Essentially, whatever we show here, this is if it's a plus, this is going to be a minus, and then back to how we sort of showed it on the balance sheet eventually, which we'll look at, is we offset that original cost by the depreciation to give us a reduced value. And we do that, with our T accounts basically. Okay, so we've talked about accumulated depreciation and net book value, and how we show you use the contra asset to reduce the value. And as I mentioned earlier, the concept that maybe you have in your everyday life, or that people who are not talking about this in an accounting context, but just in a kind of a day-to-day terminology aspect, they might say, oh, you drive a vehicle off the lot and it loses, 3,000, 5,000, maybe 10,000, who knows, some large amount of its value right away, because the circumstances around that asset have changed. And really what we're saying when we say that is we're saying the resale value of that vehicle has now dropped because the circumstances change. It's not on the dealer lot anymore, whatever, just all the circumstances have changed. So it can drop right away in that instance, right? And again, we're saying that because with that, what we're really saying when we say that the value is decreased is from a resale perspective. In other words, if we were going to go try to resell this car that we just bought, we would lose a lot of money right away. Okay. Now that's different than calculating depreciation for an accounting application, because what we're going to do, again, as I mentioned earlier, is allocate the cost of that asset evenly over the life of the asset, the useful life of the asset. So we don't go in and say, oh, we bought this $10,000 piece of machinery and we're going to reduce it by 50% day one because the resale value has decreased. From our perspective as accountants calculating depreciation, we're not looking at this from a perspective of a resale value. We're looking at it from a perspective of useful life. How long will the company be able to use this asset to do the thing it's supposed to do? So if it's a car, we might estimate that it's going to last us for 5 years, 7 years, 10 years, something like that, whatever. That's an estimate that we have some leeway around. And so again, to do this calculation, we just take that historical cost, we subtract out this concept of residual value, and the residual value represents what we think we would be able to sell that asset for at the end of its useful life. In other words, we're basically estimating that even when the asset is no longer useful to us, so in the car example, maybe say we're going to use this business vehicle for 7 years, and we think that at the end of those 7 years, we're still going to be able to sell that vehicle. It'll have some value, but for our purposes and use in our business, we're going to sell it at the end of those 7 years, regardless of the fact that it still has some, value to someone else. We're going to make a decision, and again, this is just up to the individual business and the owners and accountants, etc. But we're going to make a business decision to say after a vehicle has been with us essentially for 7 years, we're going to replace it, and we're going to sell that vehicle. Again, it's not like we're going to go drive it off a cliff or blow it up. It still has some residual value. We'll get some cash back at the end of the 7 years. But for our purposes, we're going to go buy a new vehicle. Basically, that's just our business policy, essentially. So anyway, well, you in terms of questions, you'll see in the text or on an exam or quiz, you'll be provided with the residual value. So it's not and a useful life. So it's not technically something you'll have to estimate, as a student. But in the real world, these things are both estimates. We know the cost; that's just what we paid for it. But these two things are estimated factors. And this basically just tells the same thing that I talked about. Okay, so let's look at an example here. So in this example problem, this instance, we bought a machine on January 1st, 2018 for $10,000. We expect it, again, we estimate it to last 5 years, and we estimate it to have a residual value. We think after 5 years we'd be able to sell this for $1,000. So based on that calculation formula, again, we bought it right on the first day of the year. And so we will, and maybe in the future, have to account for the fact that we could purchase, often we purchase these assets just throughout the year. So a whole year of depreciation doesn't always get recorded in every year because you might have bought it partway through the year, for example. But in this problem, very simple, $10,000. Let's subtract out the 1,000. So remember, it's cost minus residual value. So 10,000 minus 1,000. So we have 9,000. And then we divide it by the useful life, which in our instance here was, what do we got? 5 years. So we just take 10,000 minus 1,000. We get 9,000 divided by 5 years. So that is 1,800. I'm doing the math. Yeah, that makes sense. 9,000 divided by 5, we get 1,800. And we will again record that same $1,800 expense entry if we are only recording depreciation every year. Yeah, I want to do the math there. Okay, yeah, that makes sense. 9,000 divided by 5 is 1,800. So each year we will want to have our accumulated depreciation go up by $1,800, and depreciation expense of $1,800 will be the expense portion of that. And then remember, as we noted previously, as this accumulated depreciation is built up, that's the contra asset that's going to reduce this 10,000. So at the end of this first year on our books, the net book value is going to show on our balance sheet as $10,000 minus 1,800, or whatever that is, 8,200. So it'll show as 8,200 at the end of that first year. And here's a breakdown of that where here's the 8,200 I just mentioned. So at the end of that first year, the cost of the machine never changes. This is the annual depreciation expense we're going to record every year. That was the calculation we just did by taking the 10,000 minus 1,000 divided by 5. And then the accumulated depreciation is the accumulation of all of these things. So it's just building up. And this is on the income statement. This accumulated depreciation and the regional cost, these are both on the balance sheet, and they show on the balance sheet as this minus the contra asset to be a net book value. And so you can see over time the net book value decreases. That's it being depreciated. And once we've fully recorded all the depreciation that we have estimated, you can see now that we have 9,000 accumulated depreciation recorded. And that leaves us with a net book value of 1,000, which is what we thought, which is what we estimated the residual value to be. So our residual value never gets any lower because we're basically estimating that at this point it's no longer useful to us, and we would sell the machine, replace it, etc. It doesn't mean that we're required, by law or by GAAP or anything to go sell it right away necessarily, but these were our estimates, and that's kind of what the representation on our balance sheet of $1,000 would reflect the fact that this thing's fully depreciated, but we still think it has $1,000 residual value to someone else, essentially, if we were to sell it. Okay, and we'll practice with this a bit with homework problems, etc. But hopefully this provides you some background. And so which of the following is included in the journal entry to adjust for equipment depreciation? So remember accumulated depreciation is a contra asset. So a debit is a decrease because it's the opposite of assets, right? Accumulated depreciation has a credit increase. And with our depreciation journal entries, we want to increase accumulated depreciation and increase expense. And so here we see C gives us a debit to depreciation expense. Debits are increases to expenses. So C will be our answer there. And the reason that I was alluding to that, wasn't the answer is because we do increase accumulated depreciation, but a debit would be a decrease. So it would be a credit to accumulated depreciation and a debit to depreciation expense. Okay, here's an example of the depreciation calculation. So if we have a machine purchase for $25,000, we have a 5-year estimated life, and a residual value of $5,000. How much is the annual expense, depreciation expense under the straight line method? And that when it says straight line method, which is the only method that we really use in this class, we're basically when we do our calculations, it'll be the same amount of depreciation expense each year, or each accounting period, each month. Typically, you do depreciation expense per month on a month-to-month basis. So that's the idea of straight line, the terminology there. So if we take 25,000 cost minus 5,000 residual value, that's 20,000. Then divide that by 5. And so if we take 20,000 divided by 5, we get 4,000 annually. And so B would be our answer there. Okay, let's talk about the adjusted trial balance. So the adjusted trial balance, let's just look at the trial balance first here. So remember that the trial balance is a listing of all of our accounts that have balances at the end of an accounting period. And it will show whether those ending balances are debits or credits. And as long as we put all our journal entries in correctly, and every debit has a credit balance that it balances, then we should be able to see that the totals for our debits and credits equal, and that tells us that we are in balance. Okay, so that's the trial balance, remember. And really, when we're talking about an adjusted trial balance, all we're talking about is the fact that we now have a trial balance which includes all of these adjusting entries that we've been talking about. So it's really like the final trial balance that you will then want to use for preparing financial statements. For example, if we had not recorded depreciation expense, our trial balance and our financial statements, if we prepare that from the trial balance, essentially would be inaccurate because we have not captured depreciation expense yet, for example. So the idea here is just really that we want to do the adjusting entries, and we want to make sure that we capture those in the adjusted trial balance, in a trial balance. Here's a bunch of examples. I won't walk you through each of these in detail. I just want to provide you the overall context, and we'll practice this in class. But the idea they're going to show us here is that these are all a bunch of adjusting entries that will be made. And we're going to look now here at this spreadsheet or worksheet that shows us the impact of all those adjusting entries. So really, this is just a way to visually represent the adjusting entries from a trial balance perspective. So we're still going to book journal entries that we have been talking about, through this chapter. We're still going to post those to the general ledger and do all that kind of stuff. Nothing changes there in terms of what we've learned in terms of the accounting cycle and the flow. But we can prepare this extra document here. And again, this is not a financial report or anything. It's just a visualization tool, essentially, to be able to see before we did our adjustments, these were our balances. Then we did a bunch of adjusting entries. Again, we actually did journal entries and stuff. But here's just how it looks. Here's how the debits and credits changed for all of those adjustments. So for example, let's look at depreciation. So before we did adjustments, let's say we had no depreciation expense, then we did a depreciation calculation, etc. We recorded a journal entry for depreciation, and you could see the debit to the expense would be 150, and the credit to the contra asset here would be the other side of 150. And so now you can see it started with 0. We add 150 to increase the contra asset, and it ends up with 150. Similarly with expense, we had no expense to start. We recorded the expense with the adjusting entry. And so this adjusted trial balance ending is just taking the ending balance here. In accounts receivable, for example, we had an extra $1,000 we needed to record, and our adjusting entry increased accounts receivable by 1,000. We start with a debit. We're increasing that accounts receivable with a debit, so you end up at 4,000 there. See that? Something like unearned revenue, you start with a credit balance of, it's a liability, so a $2,000 credit balance. Our adjusting entries that we look at, we realize, oh, we need to reduce unearned revenue by 200 and increase revenue. We do that journal entry, which includes a debit to unearned revenue to decrease that liability. So the credit balance gets debited, and the resulting impact is that the credit balance has been reduced by this 200. So it's a credit, then we debit it, which reduces the liability, and we end up with a liability credit balance of 1,800. Okay. So again, it's just a visualization tool to be able to have some report, like, having this allows us to, at a glance, see the impact of all of our adjusting entries and how those affected the trial balance. And we can arrive at this adjusted trial balance, and we can use that to prepare all the financial statements, etc. This is really like our finalized trial balance, because if it's unadjusted, really you're just missing all of this important accounting activity that hasn't been recorded yet, and it's all of the type of activity that comes out of those accounting period end or month end analyses and adjusting entries. And so once we've got that all in, now we have a finalized trial balance that we can move forward with and prepare the financial statements from, etc. So this question says, which of the following is included in the adjusted trial balance worksheet? So trial balance after adjusting entries are made. Yeah, that sounds good. Trial balance after all revenues and expenses are closed. This is something we'll look at in a future chapter. We'll do some closing entries, but that doesn't pertain here. Trial balance at the beginning of the accounting period. No, that's not right, because our trial balance that we're looking at here, this is the trial balance at the end of the period, but just without the adjustments being made yet. And again, the closing is not applicable, so it's going to be A. Okay, cool. And that brings us to the end there. Again, we'll practice with this. There's a number of different homework problems that will have us preparing the spreadsheet, etc. And I've got the walkthrough videos and all that, like I always do. So again, just setting the stage, providing some context, providing the theory. And if you're feeling a little overwhelmed, once you dive in and start practicing and being hands-on with these concepts, I think they're going to make a lot more sense. Okay, so we're going to have just a little discussion here at the end of this chapter about ethics and internal controls. We've talked about this previously, so I won't go into the exact definitions of these things, but in this chapter we want to talk about how adjusting entries, for example, could be a risk factor or an area where ethics and it could be kind of violated, and we can talk about how internal controls can help to prevent those issues from happening, essentially. So one way that you could unethically manipulate your financial statements through really the purposeful exclusion of an adjusting entry is in this type of instance here, where it says, we've learned in this chapter that interest, for example, should be accrued, your principal times interest rate times the time period that we looked at. We should be recording interest expense on our income statement. But if we if the company fails to record that interest expense, it's going to maybe make us look like our net income is higher because our expenses are lower, and maybe that's favorable for a banker or some interested party to see. It makes us appear to be more financially successful, I guess. That's an option. Or maybe management bonuses are tied into a certain net income goal, for instance. And if we don't record the interest, we'll hit that goal. But maybe if we do record the interest, we fail that goal, for example. And so again, we as the accountants here doing the calculations, doing these accruals, we play a key role in ensuring that we have captured all the appropriate expenses for a given period. And so what we're saying here is we as the accountants, we are responsible for that, and we should be aware of that. And there's always there could be pressure, I guess I should say, to sidestep some of our responsibilities if it provides some sort of benefit to you individually, or to the company, or to the owners, and so on and so forth. So this is just highlighting that ethical situations could arise in these kind of instances. And sometimes even not so much from a fraudulent perspective, but maybe you just don't have a good system in place and you forget to record your expenses and accrue the interest payable, for example. So they talk about an internal control that could prevent that type of situation. And that would be having some sort of review process to analyze the terms of all the debt contracts for the outstanding long-term liabilities, notes payable, etc., at the end of an accounting period. And so what I would, and just from a real world perspective, I've used a tool or developed tools like this where you would maybe have a spreadsheet that has all of the different loans and different debt contracts, as it calls them here. A business might have more than one loan, for example. And so you'd probably do well in your business to have some sort of tracking spreadsheet that would highlight the key pertinent details, like things like what is the interest rate, what's the current outstanding principal, what is the term of that note, for example, and all those things, so that at the end of each accounting period, someone in the accounting department can look through and ensure that all the appropriate adjusting entries, have been made. And usually they're pretty consistent, so it's not a very onerous task to develop these kinds of tracking documents and spreadsheets, and they really come in handy when preventing situations like forgetting to record some sort of interest expense, or failing to accurately account for all of those kind of items. There's this Sarbanes-Oxley Act that we talked about previously, I think in chapter 3. And for companies that are publicly traded, so if you can go buy their stock, on the stock exchange, there's additional requirements under the Sarbanes-Oxley Act where they do require the CEO and the CFO to sign off and certify that there's no, the financial statements are fairly presented, we would say. In other words, there's no significant misrepresentations. And if the CEO and CFO are violating those or lying about that information, they can specifically be fined or imprisoned, kind of white collar crime type stuff, if they are doing something fraudulent. Okay, so to wrap up our lecture here and summarize everything we learned in this chapter, we talked about the purposes of making adjustments. And as we've seen through all the individual examples of the types of adjustments, hopefully this has become more clear to you. But we do need, the big picture idea is that we need to make these adjustments to ensure that all the accounts are accurately reported. For example, if we didn't record depreciation expense and then we prepare our financial statements will not be accurately reported because it's missing those adjusting entries. Okay? And those adjusting entries, as you've seen, kind of fall out of they're not in the same category as those recurring, transactions for purchases or revenue type transactions where you're just, provide a service and the customer pays you. These things, all these adjusting entries are kind of things that require some additional analysis. They require the accountants to have a good understanding of all the components of depreciation and interest expense and debt and accrued expenses, maybe unearned revenue, so on and so forth. So they're kind of outside of that normal day-to-day activity category. And so as we talked about in specifics for accrued revenue, we would be analyzing what we have, if we have any revenue that we need to record at the end of an accounting period, by increasing accounts receivable and increasing service revenue. Accrued expenses may need to be recorded for things like salaries payable, like we talked about. Maybe there's a portion that we owe our employees, but we're not actually going to pay them until the following month, but we need to go back and do this accrual and accrue those expenses to make sure, and we're going to use salaries payable and salaries expense to ensure that that expense doesn't all fall into one month or the other, but is instead split into the appropriate accounting periods. Unearned revenue is that liability. That's customers prepaying us. So we might need to go in as the accountants, review our unearned revenue schedule, and ask maybe our service people or whoever it is, and we need some sort of information flow to be able to find out whether that revenue is no longer unearned. Has the service been provided? Has the product been sold? And if it has, we'll have to go in and do some adjusting entries to reduce the liability and increase the revenue if that is warranted. Prepaid expenses, we talked about these quite a bit so far. This is just, for example, looking at our prepayments for things like rent or insurance, and as the months pass, or whatever trigger it is that makes that prepayment go away and actually turn into a real expense, it's no longer prepaid. We need to understand that and then record that by increasing an expense and decreasing the prepaid expense asset. Depreciation is a new topic that we talked about, where our plant, property, and equipment, or in other words, long-term assets, are going to be, the value of those will be reduced over their useful life. And we do that by increasing depreciation expense and also increasing this new type of account called a contra account. And specifically for depreciation, we're going to increase that account is called accumulated depreciation. And then that accumulated depreciation account reduces the historical cost to arrive at a net book value number, which is what we will ultimately see as the value on the balance sheet for that long-term asset. And then we talked about an adjusted trial balance. And the idea there is just ensuring that all of our adjustments are captured in the trial balance. And we can use that spreadsheet, that worksheet tool, to specifically see exactly how each one of the accounts is adjusted. And it shows you the pre-adjusted trial balance, unadjusted is the title used, and then the adjusted is the finalized version that captures all of these types of things: depreciation, prepaid expense adjustments, so on and so forth. Okay, and that brings us to the end of the chapter. And I know these concepts are a little bit broad. I think they encompass a lot of different types of accounts and situations. So again, I would probably say this in a lot of the chapters, but this one, I think it does require a lot of hands-on work to be able to fully grasp what's happening with these different types of adjustments. I don't think the understanding of an adjusted trial balance necessarily is too confusing or whatever, but I do think to understand each of the individual types of adjustments and the journal entries that go along with those is really going to require some practice. So that's what we'll do in class and in the homework and the workbook exercises, so on and so forth. So, all right, well, thanks everyone for hanging out with me through this lecture on Chapter 5, and I hope you all are having a good day, and I'll talk to you soon. All right, bye everybody.